To you about this company right now. This company we just brought public is now publicly traded. It's traded on the NASDAQ, the over-the-counter market, where we began today. Or it could be traded on the New York Stock Exchange, the Amex, Boston, Chicago, Philadelphia, Cincinnati stock exchanges, some of our regional exchanges. And the actual buying and selling and trading of the security and the transactional fees that we charge clients is regulated in what is called the secondary market, known as the aftermarket, because it's after the security has gone public, by the rules and regulations and trading rules set forth by the Securities Act of 1934. 33, new issue registration. 34, trading rules. Now, let's talk about who's making money right now. Well, the only people that are making money are three parties. Hopefully clients in the form of potential capital gains based upon your timing and selection skills of recommending an oversold and undervalued idea, looking to capture a bid price on the rising momentum that's higher than the offer to show him those gains. You and the financial advisors looking to make money in the form of the transactional fees of the commissions that you charge clients and or the markups or the markdowns when acting in a principal versus an agency capacity. And the broker-dealer that you work for, Merrill Lynch, Morgan Stanley, Dean Witter, they're making money in their own inventory proprietary trading account. Where's the issuer? The issuer is long gone with the use of proceeds of the $10 million to the $12 million, using that capital for its financing needs. The issuer is out of the picture in the secondary market. All that's involved here with the issuer is looking for them to report quality earnings over a 4-quarter year that could increase the performance of the stock's price based upon pure buying and selling and trading in the market. Are you with me so far? Yes. You, clients, and the broker-dealer you work for, these are the parties that are making money. Now I want to talk to you about stock pricing. It used to be that stocks were priced fractionally, where the 1/8 of a point represented the benchmark of how all stocks were priced. Are you with me so far? Yes. The 1/8 as the benchmark and its 16th or 32nd expression of eighths, where each 1/8 of a point movement into the stock represented 12.5 cents, and each full point movement in the stock represented a $1 price fluctuation. Are you with me so far? Yes. And for many, many years, stocks were always priced fractionally in eighths. Are you with me so far? Yes. But the SEC came in with new legislation several years back, and this legislation is called price decimalization. Price decimalization changed the way securities were priced fractionally to have them priced in dollars and cents, right down to the nanopenny, not to the penny. And the reason for that was by changing the way securities priced, and now have a conversion in the market from its fractional pricing into dollar and cent pricing right down to the nanopenny, you would then, by pricing it right down to the nanopenny in dollars now rather than fractional pricing, narrow the spread between the bid and the offer price, which would tend to lead towards greater stock price liquidity, because the narrower the spread, the greater the liquidity of the security. Am I right? Yes. So the whole purpose of price decimalization, pricing securities in dollars and cents rather than fractional expression, is to give the market greater stock price liquidity. And so there is no security in the market that is not fully converted into dollar pricing. Are you with me so far? Yes. Now, even though we verbalize the price of that stock, 5 1/4, 3 5/8, 2 3/16, are you with me so far? As an expression of fractional pricing, verbally, it's not priced fractionally, it's priced in dollars and cents. Are you with me so far? Yes. A little bit about stock pricing, right down to the nanopenny, to give the markets greater liquidity, because it narrows the spread between the bid and the offer price. And when you narrow that spread and make that bid close to that offer, you have greater liquidity to the markets. Are you with me so far? Yes. That was the whole purpose, and it was well done. A lot of what you're about to see now you've seen before somewhere and earlier, but other areas you have not seen. This is a short segment, but stay with me, because we're going to end on a huge strategy, and it's coming up real soon. We talk about the language on 11.2 in the body of my work and your work of principal versus agency, and we know that language now. And what do we know about that language? We know that those are capacities within which you may act to the transaction. And we know that when we act in a principal capacity to the transaction, we charge markups of no more than 5% above the offer. And we know that principal transactions always have the firm risk its capital because they're going long proprietarily in inventory and always owning the stock. When we act in an agency capacity, what do we know? The firm never owns the stock and inventory. There's no proprietary capital risk. We're simply going out there as an agent for you, for your client, through your trader, to execute the order, and therefore agency transactions justify for commissions. Are you with me so far? Yes. But I want to take this language of principal versus agency capacity and transactions to a higher level. And so I want you to listen to what I'm about to show you. There are many different types of companies that are down here on Wall Street, investment firms. Are you with me so far? Yes. There's an investment firm, a company down here on Wall Street, that may be called a dealer institution. Now I want to tell you the definition of what the word dealer means. A dealer is a company that was approved by FINRA to come in this industry to perform a very specific type of business, to trade their own money for their own trading account every single day for their own capital risk. That means that dealers are forbidden to pick up that phone, contact clients through cold calling, and solicit assets. That is brokerage and the function of transactional solicitation, stock brokering. Are you with me so far? Yes. That's a brokerage firm. Are you with me so far? Yes. So what do dealers do? They put up their own money in their own trading account, and they trade that money every single day. Not once in a while, every single day. Now, I can give you the name of a very prestigious dealer institution that's right down here on Wall Street at 120 Broadway. And the name of this institution is called Tradex. If you go up to the 38th floor at 120 Broadway, walk right into Tradex's headquarters, I want to tell you what you're going to see. You're going to see 40, 50 people sitting behind these systems, these terminals of execution. These are not financial advisors. These people are citizens of the United States. They are just regular people. They put up $25,000, which is the minimum requirement of their own money. They get a trading account. They get research given to them, and they work and they trade for themselves their own money every single day. Are you with me so far? Yes. Now, if Mr. Johnson calls up Tradex and says, Tradex, I would like to open up an account with you and buy 5,000 shares of Qualcomm. Can you open up that account for me? Now, the dealer can do that because the dealer didn't solicit Mr. Johnson. Are you with me so far? So what is the primary focus of what a dealer institution does? And don't forget this, to trade their own money with their own account at their own risk every single day. And they can also execute Series 7 an unsolicited public customer order. But I promise you, and I assure you, you are not going to see any of those 40 or 50 people over at 120 Broadway pick up that phone and call up Mr. Finkelstein in his house at night like you will, because that is a solicitation of a transactional business of brokerage, trading for the account of others. And so we have different types of institutions down here, don't we? We have dealers that trade their own money proprietarily and can execute an unsolicited public customer order. And then we have other firms that are down here that are called brokerage firms, right? They are where you work on the phones, cold calling clients, soliciting assets, issuing recommendations, managing that money and trading that money with the marketplace for commission business transactionally, and that is for the account of others. Are you with me so far? Yes. Most institutions in our industry, not all, are what are called full service, watch this, BDs. Do you own a BD? Do you work for a BD? Broker dealer. They trade their own money, most firms. They have their own trading account every single day, proprietarily, and they also, on a solicited basis as a brokerage firm, solicit for the account of others. Are you with me so far? Yes. So most firms, not all firms, are full service. Now, I always liked that show Jeopardy because I never felt more inadequate than I watched that show because I never get anything right. Unless it's maybe in the financial markets, and then I'm right there and I'm screaming and yelling. And I got to tell you something about these institutions of dealer versus broker, and I'm going to take this language to another level, and I want you to watch something right now. If I say the word dealer to you, would you say the word agent or principal? Would you say the word commission or markup? If I say the word broker, would you say principal or agent or markup or commission? So why don't we go through this right now? Dealer, principal, markup, broker, agent, commission. Simple. You got it? Say yes. Yes. NASDAQ. Just stay with me on this ride. Why don't you come along with me on this ride? Because I'm really that good, okay? I'm lights out, and I'm not modest about it, and I better feel this way because your future is right here. Well, we talk a little bit about the Securities Act of 1934, which has the trading rules that allow us to buy and sell and trade client assets with the market transactionally. Are you with me so far? Yes. And if I say the words on 11.3 Reg T, Regulation T, what do you think of? Reg T. Well, what do you think of? What comes to your mind? Regulation T. Well, you gave me a percentage. Okay, I'll take the percentage. The word is margin. Regulation T, listen to me very carefully, is a Federal Reserve rule and regulation that provides for the extension of credit by the broker-dealer to the client when he buys stock on loan. And the percentage is? So 50%. So let's take a look at a trade. Please look at me because you can read the books tonight. I want to teach you right now. Client calls up today on 9/14 and he wants to buy $100,000 worth of Intel on margin. Client fills out the margin agreement and he abides by the rules of margin trading and gets approved for a credit check into his background, and now he's approved for margin trading. Reg T says that we will lend him 50% of the buy. The buyer's $100,000 worth of stock on leverage. Am I right? Yeah. We're going to lend him $50,000. The other 50% of the buy is the client's margin deposit. Are you with me so far?
Yes.
When does he have to deposit the other 50% of the buy? In what is called the settlement of the margin account. Are you with me so far?
Yes.
Trade day plus? Trade day plus?
5
business days. TD5. So look at me. I'm not done. I'm in the middle of a trade. Stay with me. Today's 9/14. Client gets approved for margin trading and wants to buy $100,000 worth of Intel on margin. So we lend him $50,000. Now he has to deposit $50,000 in TD5. TD5 is equivalent to 7 calendar days, which means Saturday and Sunday. Settlement is 9/21. If the trade date is 9/14, am I right?
Yes.
Am I right?
Yes.
9/21 rolls around, the client fails to meet Reg T. He failed to meet his margin deposit by the settlement of the margin account in the Securities Act of 1934. Regarding the maintenance of the client's margin account now, we're at the trading rules right now. What do we do? What do we do when the client fails to meet Reg T and TD5? Oh, no, sir, no longer. That was in a cash account. Not now. There's no extension. We freeze the account for 90 days, and no further extension of credit will be granted to the client, and that lies under Reg T, the 4th paragraph down 11.3. Freeze the account for 90 days. If he fails to meet Reg T and TD5, 11.3 under Reg T. Are you with me?
Yes.
Are you with me?
Yes.
I want to make sure you're with me. Take a look at 11.4. There's a box at the top. Do you see it? That's right, right there. That's where I want you to be, Priscilla. See that box right at the top? 11.4. Go to it now. Stay with me. Move along with me on this. That's it. That's exactly what I wanted to be, Jose. Are you all there? Are you all there? That's okay. Well, look at me. That's okay. All that does is talk to you about the summation of the settlement date procedures. And, transaction on the left. Take a look at that. Transaction on the left where they talk about the security. Corporate securities, which are stocks. Column middle, the settlement in a cash account is TD3. Column wide right, is the settlement of a stock purchased on margin is TD5 business days. Do you see that there?
Yes.
The settlement of the account. Also for settlement, where you see municipal bonds.
Yes.
Column middle, municipal bonds purchased in a cash account settles TD3. Govies settling in a cash account, TD1. Options, TD1. Let's not worry about munis and govies settling and purchased in a margin account for today. Are you with me so far?
Yes.
So it just sums up your settlement date procedures. Well, I got to tell you, we came here today in our first day of education to wrap up this first day with a tremendous strategy. And it's going to require just trade with me just a little bit longer because I'm almost done with you. And I want to talk to you about short selling. The strategy is a bear. We have another side to the margin account. One side to the margin account that we just saw, we know a little bit about, not much. We'll see more in depth when we get to margin trading and strategy week and week 2, is when the client calls up and he wants to borrow money to buy securities, and we'll lend him up to a maximum of 50% of the buy. Are you with me so far? Yes. That's when he wants to borrow money, and we're going to lend him money, and he's going to deposit the other 50%. Are you with me so far?
Yes.
But what happens if he wants to borrow stock? We might lend him stock. He might want to borrow stock because he believes, she believes, that that stock trading right now is trading at a price that he believes will fall. And the idea is that if we lend him stock today, lend him, he's got to replace it back to us. So you with me so far?
Yes.
And then when he sells those borrowed shares to the open market, that is called a short sale. The word short means the sale of borrowed stock. Are you with me so far?
Yes.
And the word short means to sell borrowed stock. What is a short sale as opposed to a straight sale? A straight sale, are you with me so far, is when you sell stock that you own that you fully paid for. Nobody can tell you when to sell that stock. Are you with me so far? You can sell it anytime you want. You own it, you paid for it in a cash account, it's yours. But a short sale is the sale of borrowed stock. Now, why would a client call up a brokerage firm, borrow shares, and sell those shares short. Just simply means the sale of borrowed stock, because he believes that by selling that stock short at this price, which he believes is at a high price, and that stock he thinks is going to come tumbling down, then when he's required to go into the marketplace to buy the stock, don't say buy back, because that assumes you originally bought it. To buy the stock, to replace the shares back to Merrill Lynch that he borrowed, that he would be able to buy it at a lower price, and therefore generate a capital gain on stock price depression. The strategy is a bear looking to generate capital gains on the depression of a stock's price. Let me show you a trade, and I'll show you just how powerful the strategy is. There is a stock trading in the market right now. If you'll allow me the opportunity, at 90 a share. Stay with me on the trade. I don't want you to read. I don't want you to do anything. You believe that this company's stock price is going to come down in price, and I'm going to tell you why. The company shot an early warning signal over Wall Street that they're going to fail to meet earnings expectations. Right there, that's enough to sell the stock down. Are you with me so far? Yes. And crush it and pummel it. I don't have to go into the level of corporate malfeasance of the Tycos and the Imclones and the Arthur Andersons of the world, of accounting fraud, to suggest why a stock price might come down. Simply today, in this sensitive market, are you with me so far? If a company fails to meet earnings expectations, that stock's coming down. And you believe it's trading at a high right now. Now, you don't own it. And so the last thing you're going to do is buy a stock you believe is coming down in price. Are you with me so far? Yes. So one way of making money on the potential depression of the stock's price is to short it. And so we call up Merrill Lynch, and the client borrows 1,000 shares of the stock. The number of shares in the position here is 1,000. Are you with me so far? Yes. 1,000 shares are given to the client. He borrowed it. Are you with me so far? Yes. Stock is trading at 90. He sells short 1,000 shares, which is the sale of 1,000 shares of borrowed stock to the open market, trading at 90 a share. When you sell stock short, just like when you straight sell, you are selling. Are you with me so far? Yes. Money's coming into you. And how much money is coming into this client's account? The short sale of 1,000 shares of stock at 90 a share is going to have coming into the account $90,000. Are you with me so far? Yes. Comes into your account. Are you with me so far? Yes. Kind of exciting when you think about the size of the position. Now, at some point, you have to believe that when the stock price comes down as you expect, you are required to come into the marketplace, buy the stock, buy the 1,000 shares, and replace it back to Merrill Lynch that you borrowed it from. Am I right? So because now when you believe it might have bottomed out. Are you with me so far? Now any price that you buy below the price of the stock sold short, you're in the money. Am I right? Now because I'm one for the dramatic, what if I show you a 30-point decline in this stock's price? It's trading at 60. You think it's coming down no lower. You think the stock has hit bottom. It's crushed. It's pummeled. Are you with me so far? I just show you a dramatic move. Are you with me so far? I could have told you $87 a share. Are you with me so far? That's a 3-point decline of the stock price and where you sold it short. Are you with me so far? You might say, look, at 87, a 3-point decline to the stock's price, you know, she's not going down any lower. Let's go with 60 because I like to see big numbers jump out at me because it gets me excited. Here's a 30-point decline of the stock's price. Now you have to come into the marketplace and buy 1,000 shares of that stock at 60 a share. And that means you're going to lay out 60 grand, and you replace the shares back to the broker-dealer. You covered your short sale. The short sale is the sale of 1,000 shares sold short at 90 a share. To cover is to, in the language of short selling, replace the stock that you borrowed from Merrill Lynch. Sell that stock short high, cover low, and generate here a $30,000 capital gain on stock price depression. Any price that stock is covered below the price of the stock sold short, the word covered means bought, shows the strategy of bear and generating capital gains on stock price depression. Are you with me so far? The SEC says short selling, which is the sale of borrowed stock, is artificial selling. Well, that goes to what is the definition of what is real. What is this, artificial intelligence? What's with this ambiguous word? Well, the definition as to what is real in the market is stock that you own, stock that you fully paid for in a cash account with your money. That is clearly real. Are you with me so far? Yes. Any other form of transactions in the market with the buying or the selling of securities with stock that you do not own that you are borrowing is considered an artificial sale. Are you with me so far? Yes. Based upon what is the definition of what is real, which is stock that you own. Are you with me so far? Yes. So the SEC says, listen, you are required to borrow that stock and short it only during certain periods of time in the market. So far, you can't short a stock anytime you want. And so the answer as to why is as follows. What if a stock price is already trading down in price? It's down 2 5/8. It's down $4 a share. If you were allowed, if you thought it was going down even further, if you were allowed then, when the stock is already down in price, to borrow stock and short it when it's already down in price. Are you with me so far?
Yes.
What would that artificial short selling further do to the performance of the stock's price? It's going to further take it down with stock you don't even own. So in order to avoid, listen carefully, the artificial crashing of a stock, the artificial depression of a stock's price, short sellers are told when they can short a stock. Stocks move in ticks in prices. Stocks move in ticks in prices. Are you with me so far?
Yes.
An uptick means it's up from the previous trade. A downtick means it's down from the previous trade. The SEC short sell rule is designed to allow short sellers only to borrow stock and sell that stock short when the stock is trading on a plus tick or a 0 plus tick rule. Let me show you exactly what I mean. Let's take a look at a trade. I want to show you that when securities are executed to the open market, I told you in 90 seconds for listed stocks, they are then reported to the consolidated ticker. Are you with me so far?
Yes.
So let's assume that the market is just opened, it's 9:31, and here's the first trade in this stock. This stock comes over the ticker, and this is what you see. A fractional verbiage, but it's priced in dollars and cents, 49 1/8. Now, if there's no volume representation represented to the ticker, are you with me so far? It automatically assumes to be 7, round lot. That means 100 shares, and the ticker will tell you if the stock was bought or sold just that it was executed. This means 100 shares were either bought or sold in that stock at that price of 49 1/8. Are you with me so far? Next tick. Next trade, this is what you see, 49 1/8, same price, another round lot. Are you with me so far?
Yes.
Now, is the second price any change from the initial open? Say no. Say no.
No.
I'm going to change the pricing on the stock right now. Now watch this. Opening trade is 49. Second trade is 49 1/8. Are you with me so far?
Yes.
Look at the second trade into the stock from the previous open. This is a plus tick. This stock is up an eighth from the initial open. Are you with me so far?
Yes.
You can short the stock when it's on an uptick because by being up in price an eighth, are you with me so far?
Yes.
It can absorb some of that artificial short selling. Let's take a look at the third trade into the stock. Third trade into the stock is 49 1/8. Is that any change from the previous? Say no.
No.
Was the previous up from the initial open? Say yes. This is called a 0 plus tick. No change from the previous, but the previous was up from the open. Are you with me so far? You can short the stock as well here on a plus tick or a 0 plus tick. Take a look at the fourth trade in the stock, 49. 49 is a negative tick, a negative eighth. You are prohibited from borrowing stock and artificially short selling when the stock is trading on a negative tick because you're going to only artificially further depress the stock's price with shares of stock you don't even own. Sell that stock short high, cover low, and generate a capital gain on stock price depression. And when I show you the magnitude of short selling in week 2 and talk to you about the great bear dance, you'll understand why in the greatest history of this market, the most amount of money that was made in the entire history of this entire U.S. economy and Wall Street financial market was the day after the crash of '87 on Black Monday, where people covered shares of stock at prices that haven't been seen since. Are you with me so far? Before there were bulls, there were bears. Wow. We'll take short selling and long buying on margin to a greater level when we get into strategy week and margin week, and that's the first day of your training, and I'm really excited, and this is kicking it off, and I don't know how to shut it down. Why don't you give yourself a round of applause? I want to share with you some documents that I have for you, give you a curriculum to get yourself ready for tonight, and I mean tonight and tomorrow, and get yourself ready for Wednesday. Are you with me so far?
Yes.
Take a look at me. All eyes on me. Promise you my material when you came in the program, so look at me. If you watch me carefully, you won't get confused. The first document that you have in front of you is entitled the NASD. This is my publication that I've written which complements your chapter 12. Are you with me so far? Again, studying from 2 sets of 7. Are you with me?
Yes.
My documents are always the white before you come in. Are you with me?
Yes.
Second, you have another document here called, look at me, new customer accounts. This complements your chapters 2 and 3 in the body of your work regarding the opening and the maintenance and handling of customer accounts. And I think tonight as you start to read it, because you have to review it tonight, you're going to start to say things to yourself like this. Wow, it sounds just like this guy. It better. I wrote it. Are you with me so far?
Yes.
Good. Now the second document, look at me. It's rather thick and it's stapled. I got so many things for you. You know, this is the 7 after all. You know, we got to take 2 steps back here. Are you with me?
Yes.
And this document is entitled, do you see it? It's stapled. Are you with me?
Yes.
I just need a yes. If you're not, look, I can't see you anymore. Are you with me?
Yes.
Good. I don't have dementia yet. It says the primary market on it. Turn to page 34, bottom right. I'm sorry, 32. I got it for you, Jose. What does it say at the top of page 32? Secondary market. You know what? You are hot. You are on a roll. This document is my publication that complements from page 1 through 31 your chapter 9 regarding the prime market for equity IPOs, and beginning on page 32 to the remainder of the chapter, the secondary market, which complements your chapter 11. What you're looking at is my theory. Are you with me so far?
Yes.
Oh, there's something else there. Jesus, what's that? A quiz. Hey, what's going on here? Didn't I say I wouldn't test you? Look at me. I'm not. You know why? Because it's got the answers right there. The test doesn't have it. So you're in so far.
Yeah.
Get your pens down and listen to me very carefully. From this moment on, I told you when I met you, we're running to knock out the 7 in less than 45, 50 days. I'm going to show you how to do it. Are you with me so far?
Yeah.
There has to be 2 schools of training working in synergy at the same time. First, there's the program and 9 days in the actual language and the regulations. Are you with me so far?
Yeah.
Through trading, we'll master every fine point together over and over again, because I'm going to highlight it and impute it in your soul. Are you with me so far?
Yeah.
But knowing the regulation and understanding the language is not enough. Because the test is what? The transactional. So how are we going to pass the transactional sort of examination? What you're about to hear is a winning formula that's lasted 20 years. It's causing me to have a 94.3% pass ratio on the candidate's first shot at this exam in less than 45 days for 15 years running. And I want to show you this formula right now, so don't break it. You're going to take the language that you learned from these days, and you're going to start reading transactional questions to a much more professional and acute level from the training program. And I'm going to show you exactly what that means right now. Because once we start the reading of transactional questions, followed by the answers and explanations, without selecting, I think it's A, wow, D looks good, I don't want you to select it. While you're reading these questions, are you with me so far?
Yeah.
This is having the answers right out there. You're working with the answers, like your safety net, in an open book form. You read the questions, listen to me carefully. You read the choices. I don't even want you to speculate. Boom, you go right to the actual explanation, and it'll tell you why C is correct and A, B, and D are incorrect. Are you with me so far?
Yeah.
This refreshes the language and the regulations, then more importantly concentrates on the second level of training and working in synergy, which is the transactional experience. So that by the time you graduate this program, you've read transactional questions from the moment with the answers and explanations in the language that you were professionally trained. Then we can start working with our ROM work and working with tougher transactional questions as we work our way all the way up to NASDAQ's experience. Are you with me so far?
Yes.
Come along with me. It's a winning formula. I'm smiling because I know it's going to work for you if you just do what I tell you to do. So if I answer how some of these chapter exams or review quizzes are coming along, and you answer me with responses like, you know, I'm getting more wrong than right, I'm going to choke the life out of you. I want you to get them all right because I want you to learn with the reading of the transactional questions with the answers. Are you with me so far?
Yes.
To revisit this transactional experience, which has to start now. Until when? Until we march into NASDAQ and then we're licensed. So listen to me very carefully when I say open book. And your lesson for tonight and for tomorrow is not discretionary. So if I were you, I would write this down because this is required. Do what I tell you to do, you'll be licensed quickly. First is that we have to reread chapters 12, 2, 3, 9, and 11 with a newfound level of education behind us. I think when you reread it tonight, I think it'll make more semblance than it did in pre-study. So reread chapters 12, 2, 3, 9, and 11. This is always the way it'll be relative to the chapters that we're covering on a given day. Step 2, in order, look at me. The notes from today, and there were many, along with their perspective that I gave you for NASDAQ, which was significant for the actual sevens experience. Are you with me? Step 2, the notes. Step 3, you want to read my body of work on the NASD and new customer accounts and the primary and the secondary market, which I'm giving you today that I just went over. And at that point, with an extensive amount of reading, I think we should take a break so that you're not mentally exhausted. I know just when you want to take a break, just when you can keep going. Are you with me so far?
Yes.
After dinner, in a shower, or a latte, or hitting golf balls, or whatever it is that you do so that you don't freak out too much. Are you with me so far?
Yes.
I want you to come back in, and I want you to take a look at your new issue chapter exam. There is a document that I gave you recently in this program here today. And the document has, to all candidates, a certain number of questions. Do you see this document? Look at me. I want you to pull this document out. I want to tell you why I want you to follow and look at only these questions of the 50 in the new issue chapter exam. Unlike most chapter exams that I'll give you, this particular chapter exam is a little unique in that, listen to me carefully, these 50 questions do not just cover new issue IPO equity rules regarding how stocks go public. In here are also new issue equity rules regarding municipal bonds and government securities, as well as equities and mutual funds and tax shelters that I haven't covered. That's why the only questions that I want you to look at, and there are only a few here, out of the 50, no more than 10, are the questions that I have specifically highlighted for you, and I'll tell you why. We'll take a look at this. It begins with the reading of question 2 tonight. Are you with me so far?
Yes.
Let's take a look at why number 1 is not on the list. Look at question number 1. Are you there?
Yes.
Are you there? You have a chapter exam out?
Yes.
You can double up with Priscilla if you don't have it there for you. You have a chapter exam out? Double up with him so you can see exactly what I'm talking about. Double up with him. Under MSRB rules, stop, time out. I didn't discuss MSRB with you today. That's the Municipal Self-Rulemaking Board, which regulates the IPO process, secondary market trading rules for municipal bonds. That's why that question is not on the list. Look at question number 2 and why that is on the list. Which of the following statements are true about the acceptance of an indications of interest for a registered offering during the 28-hour cooling off period regarding an equity IPO? Hey, that was something that we did discuss. Are you with me so far?
Yes.
That's why, please, do exactly what I tell you to do when I tell you to do, and you'll be licensed quicker than anybody ever hit this industry. You with me so far?
Yes.
Now, that's enough for tonight, new issue chapter exam, and that's about 4.5 hours. You got to pace yourself, take your time, and that's got to be reviewed tonight. Why? Because tomorrow, we got to get ready for Wednesday, right? Right! Now, what are we going to do tomorrow? Tomorrow, ladies and gentlemen, I want you to pull out chapter 4 and 22. Tomorrow, 4 and 22, because that's the agenda for Wednesday. Let's read 4 and 22 tomorrow night, Tuesday night, and bring 4 and 22 with you on Wednesday to get ourselves ready at exactly 11:15 to start getting much more involved. Now, Wednesday's 5 times today's impact. Are you with me so far? Words of caution. I'm going to say this once to you. Each day that you come from now on is a higher level of work and a higher level of transactional curriculum. Are you with me so far?
Yes.
I said Wednesday's 5 times today. I'm going to split stocks, convert stocks, dilute stocks, and take the language that we've learned from today and start talking about dividend distributions on stocks. I'm going to talk about stock price dilution, market strategies, and then I'm going to blast right through the area on analysis. So, don't come on Wednesday with the same focus that you have today. You have to increase it a notch every time that we meet. And that means you got to dig down deep. And I'm begging you to do that now, because otherwise you'll get overwhelmed in the first 20 minutes on Wednesday, and I don't want that to happen to you. Each day that we meet is a higher level of focus, just a little bit more than the previous. Are you with me so far?
Yes.
I'm here to catch you when you fall. I'm here to pick you up. I'm going to stay with you every step of the way until you're licensed. You're not going into that building without me. Do you hear me? But I cannot do this without you. And so, let's not underestimate these days. Now you got 8 left. And I'm coming at you quick. I don't want to speed up and slow down. You can't fail with me. I just want you to trade with me and be focused. And I can't tell you how proud I am that you're in my room, and I'm proud of you. So give yourself a round of applause. And I'll see you on Wednesday. Go! Thank you. Peace out to you. One love.